Hello class, my name is Sam Dykes and today we're going to be talking about the basic of partnership distributions. So what we'll cover, the types of operating distributions. This includes distributions that are money only, as well as distributions of property other than money, liquidating distributions, and the gain and loss recognition in a liquidating distribution, basics in distributed property, so a partner's outside base can be greater than an inside base of distributed property. What happens when a partner's outside base is less than the inside base of a distributed asset, and character and holding period of distributed assets. So distributions of money. The partnership doesn't recognize the gain or loss on the distribution of property or money. Tax rules also don't require a partner to recognize the gain or loss on the distributed money, and a partner only reduces their partnership interest by the amount of money distributed. Distributions of property other than money. If a partnership makes a distribution that includes property other than money, the partners must determine how much of the outside base to allocate to the distributed property. Partners will take a base in this distributed property equal to the partnership ownership in the property. So if you own 20% of the property or the company, and you distribute 20%, you'll take 20% of the property distributed. When the partnership distributes property other than money with the base that exceeds the remaining outside base, the partner's outside base is then reduced to zero. Liquidating distributions. So this has to do when a company or a specific owner chooses to liquidate their interest in the company, and reduces their interest to actually zero. In a liquidating distribution, the partner retains no interest in the partnership. They end their ownership within the company. And the two issues that arise from this are how to determine whether the terminating partner recognizes the gain or loss and how to allocate the outside base to the distributed assets. Partner's outside basis is greater than the inside base of distributed assets. So we have two scenarios in this case when there's distributions of money, inventory, or unrealized receivables, and when there are other property included in distributions. When it is just money, inventory, or receivables, this results in a capital loss. The partner assigns a base and distributes the loss to the partners. Other property, liquidating partner must also allocate the property based on the outside basis, and the partner can adjust the basis of the other property without converting ordinary gains and losses to capital, and the liquidating partner will not recognize any gain or loss from the distribution. So an example of this, suppose ABC Company has no liabilities or hot assets and distributes $50,000 in cash and land with a fair market value of $160,000. With the basis of $20,000 to Greg in complete liquidation of his interest in ABC Company. Greg has an outside base of $268,000 prior to the distribution. What is Greg's recognized gain or loss on the distribution? In this case, Greg would not recognize any gain or loss from this distribution. Partner's outside base is less than the inside base of distributed assets. In this case, there are two primary scenarios. One where there is money again, and one where there is money, inventory, and unrealized receivables. When it is just money, the partner recognizes a gain if the partnership distributes money that exceeds the partner's outside basis, or if the gain equals the excess amount received over the outside basis. When there's money, inventory, and unrealized receivables, in a liquidating distribution, the partner's outside base is less than the inside base of the distributed assets, and the partnership distributes property other than money. The partner reduces the base in the distributed assets but does not recognize a gain or loss in this scenario. Character and holding period of distributed assets. The type of assets include both unrealized account receivable and inventory. For both operating and liquidating distributions, the character of the distributed assets for the partner usually stays the same, and it was in the partnership in order to prevent conversion of ordinary income to capital gains for both operating and liquidating distributions. So in conclusion, different types of distributions that can have different tax effects on a business. Partnerships allocate liquidating distributions based on a percentage of ownership within the partnership. And property other than cash can be distributed and taxed accordingly. Sources I used were a textbook, as well as tax codes for the basis of distributed property, and another article that I found on the internet. Thank you, class. Let me know if you have any questions, and feel free to reach out to me if you do. Thank you.